Thank you for joining us for our webinar. My name is Patrick Scholl. I'm a Meyer Brown partner in our Frankfurt office. Before we begin, we would like to cover a few housekeeping items. To ask questions, please use the Q&A widget on your screen. We will try to address questions throughout the webinar. Otherwise, we will get back to you via email. For those seeking CLE credit today, please download the affirmation form and the evaluation form found in your resources widget on the screen. We will announce the CLE code once during the middle of the presentation. Please return both forms for CLE credit. The presentation and supplemental materials are available for download from your resources widget. We will also distribute these via email after the webinar. So thank you for joining today. I welcome you to this presentation about issuing structured products into the EU. Today, my name is Patrick Scholl, as I already mentioned, and I will be joined by three of my colleagues. From London, my regulatory partner, Chris Chapman. From London, my capital markets partner, James Taylor. And from Frankfurt, my colleague, Johannes Münch. The agenda, we will first give you a brief update about Brexit and what is the current status here in the EU. Afterwards, we want to give you an overview about the EU structured products market. And then we have four parts about issuing and the legal topics around structured products. First of all, we give you an overview of the capital markets access pre- and post-Brexit, the purpose of the new EU Prospectus Regulation. Then we have an overview of the new EU Prospectus Regulation and summarize very important topics for structured products prospectuses, in particular now as we have 1 year of experience with the new regulation. And finally, in our last part, we want to give you post-Brexit considerations about what happens after Brexit when you want to issue structured products both in the UK and in the EU. We will begin with a Brexit update, and I will hand over to my colleague Chris Chapman.
Thanks, Patrick. I just wanted to start with a very brief update on the current political position in relation to Brexit. We're conscious that we have a very international audience today, and we have all had a lot of other things on our mind over the last few months. So we thought it might just be helpful to remind ourselves where things are at and what might happen next as context for the discussion that's going to follow. Could we move to the next, please? So I'm going to keep this very simple. It seems like a long time ago, in June 2016, that the UK voted to leave the EU. Since then, we've had a number of political adventures. Recently, and importantly, we've had a Conservative government elected with a large majority on a strong pro-Brexit mandate. And on the 31st of January 2020, the UK finally exited the EU. Formally, that's happened, but in substance, it's occurred under an agreement, which means that in large part, the effect of being in the EU has remained. That now is due to last until, can we move to the next slide? So that's due to last until the end of this year, and that will happen at that point. The UK will exit the EU unless there's an agreement in the meantime to extend the duration. Now, the deadline for agreeing any extension is in 12 days' time, and we did wonder at one stage whether we would revisit previous situations and have a last-minute flurry of negotiations on that, but that appears now not to be the case. The UK has formally announced that it doesn't intend to seek any extension, and the EU has said that it views that as the UK's final position. So the debate in the media has now shifted to the question of whether, in fact, the two sides are going to be able to agree a free trade deal before that date. Now, when we're talking about that, we really have to remember that this is not something that is entirely up to the UK and the EU. They can't simply agree whatever they like. They can't agree one or two small points now and then leave the rest of it to be dealt with later, because this is an area governed by international laws. There are various criteria that need to be complied with. And so the debate in the media at the moment is around concerns that those criteria won't be able to be fulfilled by the deadline. Pretty much the only agreement the UK and the EU could easily agree before the deadline is a further extension, and as I've just discussed, they appear to have decided that they're not going to do that, although part of me does wonder if we might get some sort of fudged extension towards the end. Anyway, what happens if they can't agree something by the end of this year? Well, in that case, the UK's trade with the EU and likely with the rest, largely with the rest of the world as well, will then default to the WTO basic fallback position. That's been called, as you all know, a no-deal Brexit. And there's a pretty general consensus now that that will cause very significant economic damage, at least in the short term. And right now, that damage would be due to occur in the middle of the economic damage caused by the COVID crisis. And I just wanted to talk a little bit before finishing this short section about the political considerations that gives rise to. So I sometimes think that the Brexit debate underplays the importance of politics. So later on, for example, we'll talk about equivalency. And equivalency is an area where supporters of it, can identify really good reasons why commercially it would make sense for the UK and the EU to recognise and use equivalency post-Brexit. But sometimes I think they don't have sufficient regard to the fact that it may not be a purely commercial decision. And I think the most significant characteristic about the Brexit debates and the negotiations at the moment is the politicising of the EU's position. I think the UK's position has always been highly political, but now, previously I think the EU was perhaps largely commercial, but now we're seeing the EU's position becoming more political. That's been caused by two things, I think mainly. One is just exhaustion about how long the process is taking and a political desire to get it done with. And the other is the aggressive approach the UK's taking. And I think at the moment, in the context of COVID, there's an impression in Europe that if we suffer the economic damage of Brexit in the middle of COVID, that will be the UK's fault, because the one easy solution to avoid that is an extension, and it's the UK that has decided not to seek an extension. Now, what is the significance of that? Well, I just wanted to leave with this thought, which is that the EU, we should not forget, can be quite a protectionist organisation at times. It has various mechanisms which create trade barriers. Equivalency is one of those. The UK itself in the past has described equivalency as a barrier to trade rather than a way to access the EU market. And data protection, GDPR, is another area. Those of us who deal with trade into the US and other jurisdictions using data, we know what a barrier EU data protection laws can be to trade. And I think something to think about is, as political tensions escalate in the Brexit debate at the moment, and in the context of COVID, we should not only think about the reasons for making decisions, we also need to be of the political imperatives and some of the consequences of the escalating of political tension might have. So it introduces other sorts of factors. So that's where I wanted to leave the introduction, and now I'm going to turn over to Johannes for the next section of the talk.
Thank you, Chris. So welcome again from my side. What I want to do is to give you a very quick update about the current European and more specifically the German market for structured products, so that you maybe have some better context for the following topics in this presentation. So first off, I hope you all can decipher the slides. They are quite small, but maybe if something is particularly relevant to you, you can look it up later. What you commonly see in the relevant market statistics is actually a distinction between investment products on the one hand and leverage products on the other hand. Leverage products here mostly refer to products like warrants or mini futures or particularly knockout warrants. In these charts, so these are charts produced by the European Structured Investment Products Association. In these charts, you can actually see the German market, respectively, as the bright orange portion of the columns. So you can see that the German market is actually one of the biggest in Europe, and it's especially well developed when it comes to leverage products. The German market is actually mostly dominated by domestic banks. Specifically, the top three issuers that make up more than half of the market are actually all parent companies that act as providers for capital markets products to various regional banks within their respective banking groups. So these are banks like LBBW or DK that you might have heard of in a German market context as well. The products that are very common in the German market are actually mostly warrants and particularly knockout warrants. And as you can see in the pie charts on the right-hand side, for the most part, the underlying will be an index. On the last slide that I want to present to you, I would like to draw your attention to some recent developments that occurred in March of this year, which is actually the most recent complete data set that we currently have. What I think is interesting to see is that we're talking about March this year, and the global stock markets in general took a somewhat pronounced dive at that point. But as you can see here, the overall turnover for structured products, at least when it comes to trading on German stock exchanges, actually increased significantly by more than 50%, as is also nicely illustrated in the chart on the right-hand side. And what is actually particularly interesting to see is that actually investors made heavy use of knockout products to react to the volatile market conditions at that point. That was it for me, and now over to Patrick Scholl for some background on the European capital markets.
Thank you, Johannes. We will now move on to the EU market access and how does it look like and how does it work. First of all, we have a kind of a one single point of entry, so to say, with regard to prospectuses. So if a prospectus has been approved by one national authority in one of the EU member states, it can be passported in each of the other European Union countries without any further approval process being required in these jurisdictions. This passporting regime enables therefore issuers to have a very efficient approach in terms of production of prospectuses, as it was not so in the past, where you had then to have a kind of a confirmation approval in other European Union companies before the European Prospectus Directive has first been implemented. As I said before, there's just one approval necessary by one of the national competent authorities, and based on certain limitation, there is, when you use a certain denomination, also kind of a freedom to choose the national authority that you can get the approval from. There are certain limitations, but in general, if there's an issuance with a denomination above 1,000 euros, you can choose the regulator through which you want to access the European markets. As we have so many countries and so many languages in Europe, language is still a topic that regulators are concerned, in particular if retail investors are targeted. This doesn't necessarily mean that the prospectus must be translated in all languages in the European Union. If an acceptable language is used, and it's usually English, you can use this prospectus for notification in all European Union companies, jurisdictions, sorry. But if a public offer will be made, there's a requirement that the summary of the prospectus needs to be translated in the language that is required by the relevant country. This doesn't necessarily mean in all EU states that it must be translated in the national language. There are certain exemptions in certain countries that you can also, for example, use English as a language for the summary. But this has then to be verified with regard to each countries in the European Union. For example, if you want to passport a prospectus into Germany, you need in any event a German translation. There are specific cases currently, and there has been a rule change in Switzerland, for example, that gives the possibility to also use a EU-approved prospectus for public offers in Switzerland. So this has been changed. Prior to that, there was a requirement to also have a Swiss law prospectus being approved in Switzerland. Now you can use an EU-based prospectus, for example, to do public offers in Switzerland. And with regard to Brexit, and we will come back on the consequences of Brexit at the end of the presentation, but just to set the scene at this point in time, following the official final Brexit, the UK will be a third country from the perspective of the European Union. This means that you can no longer use the passporting or the notification process as is currently being provided by the European regulation, meaning that the prospectus approved for example, in Luxembourg can no longer be used in the UK. There needs then to be a prospectus approved in the United Kingdom to do parallel offerings to retail investors, both in the European Union and in the UK, if this is required, but if this is wanted. But my colleague James Taylor will give you more details on this later. So what is the legal framework of the EU market access? Not only, we don't only have prospectus law, meaning that the primary market access, in particular, if a regulated market listing or public offering is required, but we also have other regulatory requirements if public offers to retail investors, for example, shall be done. First of all, there is MiFID I and MiFID II, that implements requirements for the retail distribution within the EU, and there's also the EU PRIPS regulation. MiFID II implements strict principle on product governance. This apply both to the issuer or the manufacturer, so to say, of the product, but also on the distributor. And what does it mainly mean for the issuer, being the manufacturer of the product, is to predefine a target market for the product. So so that to ensure that the product is not sold to an investor that is not suitable for that kind of product. This should be achieved by way of this target market assessment and regulation. In addition, what also have to be in mind with regard to MiFID II is a new product intervention tools that have been implemented, so that the EU regulators have the possibility to ban certain products if they feel that these structured products could be to the disadvantage or could harm retail investors. So up till now, we have seen a few product interventions so far, in particular with regard to certain contract for differences that have been distributed to retail investors in Germany, and not only in Germany, and in other countries as well. And MiFID II also applies to investment advice. So if structured products are distributed not only by this own decision-taking process of investors, but also by using investment advisor, MiFID II regulates the investment advice and all the requirements that have to be fulfilled when advising retail investors on structured products. The EU PRIPS regulation established a short-form information document that stays besides the prospectus. So we have on the one hand the prospectus and a summary that should summarize the content of the prospectus in short form, and we only have the PRIPS kit. It's called Key Information Document Kit. This is 3 pages long. There's not much freedom when preparing such a kit. The regulation is really strict and gives detailed requirements on what to present in the kit document, in what order, and even certain warnings or disclosure parts are predetermined by the regulator, so that there's a uniform kit for each product in each issue, so that investors are able to check these different products against each other in an easily harmonized way. With regard to languages, the same applies for kits than for summaries. So in certain jurisdictions, the kit has to be produced in the accepted language in the relevant jurisdiction. For example, here in Germany, again in the German language. With regard to civil law requirements on structured products, there's no harmonization in the European Union so far. Civil law principles are still very different within the European Union. This also then has the consequence that there might be different treatment on enforceability issues with regard to structured products. In particular, the topic of a kind of an unfair contract terms perspective. If it comes to investor protection, there might be different views in different jurisdictions on what is regarded as an unfair contract term, for example, in a certain jurisdiction. So there's no harmonization, and even the case law is very different, and in some jurisdictions, it seems to us there's not an unfair contract terms test at all. When we produce prospectus, we also have to consider prospectus liability. Also, prospectus liability is not yet harmonized in the European Union. There are still always discussions about harmonizing prospectus liability regimes, but this has not happened so far because the roots of our relevant civil laws are quite different within the European Union. What, however, has been harmonized in the meantime are the liability concepts for prospectus summaries. These are set out in the Prospectus Regulation, and the liability concepts for kits. These are set out in the EU PRIPS Regulation. Other important regulations that you should be aware of when issuing structured products into European Union are currently the benchmark regulation that regulate the use of indices and other benchmarks, the current and still in developing U.S. sustainable finance package, in particular if issuers are interested to produce sustainable structured products. We had a webinar on this 2 weeks ago on this platform. and there is also an upcoming EU Green Bond standard that could also, to a certain extent, being used for structured products. I will now read the CLE code. It's 20BREX0618. You can also see this on the slide. Please include this code on your affirmation form. Both the affirmation form and the evaluation form are found in your resources widget on the screen. So we will now present on the new Prospectus Regulation. It is now being enforced for 11 months, and we have now already most of our prospectuses be updated to the new regime, and can also give you some insights on our experiences so far. First of all, we want to give you a brief overview of the new regulation. I mean, what was the decisive point in the European Union is to even more harmonize the European capital markets and have even more harmonized approach in terms of prospectuses and their contents and the review process as well as by national authorities. You can imagine having 28 national authorities reviewing prospectuses that their review process has been in the past very different, and it was still a kind of a market. There was still not a level playing field in terms of having a harmonized approach in terms of what has to be included in a prospectus or not, and what is a plain language prospectus or not. So the new Prospectus Regulation tries to harmonize the approach in terms of not only regulation, but also in the implementation of the regulation by the national authorities. The Prospectus Regulation is quite complex in terms of available resources. Yeah. If you are not familiar with EU law so far, we often have various levels of regulation that you have to take into account. Usually there's the regulation on the first level, but then there will be delegated regulation that give more details to certain terms of the regulation. This is typical, for example, for prospectuses, because the regulation of prospectuses is so intense, as also the minimum disclosure standards are being regulated, and it's not being done on the regulation level as such, but by way of a delegated regulation. It's the first delegated regulation that is set out here, that sets the requirements for the format, the content, and also the review and the approval process of a prospectus. This is the most important regulation for us in practice, as most of the content requirements are set out in these regulations. In addition, then we have the so-called level 3 measures like ESMA guidelines or ESMA Q&As. This is similar to all kind of EU regulations, and these Q&As are quite helpful in terms of certain specific questions that are open to interpretation under the regulation. And finally, there is also jurisdictional specific guidance, like in Germany, there is a BaFin guidance on the review of prospectuses that gives even more details, for example, on what BaFin expects to be a plain language prospectus. What are the material changes of the Prospectus Regulation? There has been a kind of a recalibration of the prospectus formats. In particular, there has been a simplified prospectus that has been implemented, and the EU Growth Prospectus that should help mid-sized companies to more easily access the markets and not to being subject to a very costly burden of producing very detailed prospectuses. There was a restructuring of the prospectus summary because the summary before was very complex and very difficult to read. Now the summary was restructured and limited to 7 pages, and also similar a bit to the KIT under the EU Prospectus Regulation, also regulated with regard to certain aspects like the minimum content requirements, as well as the order of presentation, so that at least there is also a harmonized approach for summaries that makes investors more easier to compare products and prospectuses of different issuers. The most important change here under the Prospectus Regulation was the restructuring of the risk factors. This was accompanied by an ESMA guideline on disclosures with regard to risk factors. I will come back to this a little bit later. And then there were certain kind of modernizations, in particular the publication of the prospectus. It is now only required to publish the prospectus on a website and no longer, for example, in paper form. When it comes to prospectus, prospectus requirements in Europe, you always have to verify whether you are in fact required to produce a prospectus. We have several prospectus exemptions. These have not been changed substantially from the previous prospectus directive exemptions. So I summarize this on slide 19 again. The most important exemption is that a prospectus is not required if it is addressed solely to qualified investors, or if there is a minimum denomination of 100,000 euros, or if the securities are traded on a regulated market to which only qualified investors have an access. Very importantly, a prospectus is also only required if a public offer is being made. And public offer means any kind of communication to the public in whatever form. Here, the definition of public offer is very broad, but it must be a kind of an information to the public. In terms of formats of prospectuses, we have now several formats of prospectuses available, dependent on what is the issue and what is the underlying instrument. I want to remind that this same law applies also for offering shares. We concentrate here in so-called non-equity securities that are bonds and structured products in a securitized form. If you use these kind of securities and need to produce a prospectus, there are then two differentiations. First of all, the wholesale prospectuses that are only used for securities that are listed on a regulated market. Yeah. For retail prospectuses, i.e., if there's a public offer, there's a specific retail prospectus format. And as I said before, there is also a called simplified prospectus and EU Prospectus. In particular for structured products, but also for bonds issued under an MTN program, the so-called base prospectus is the common prospectus used in the European Union. This prospectus is a kind of a frame prospectus that enables to document not just one kind of securities, enables to document and several kind of structures, which is particularly necessary for structured products. And the base prospectus will then be accompanied by the so-called final terms that will then be produced for each product, similar to a pricing supplement, for example. What is coming up more and more in the European Union, because there's now much more clarity, is the so-called tripartite prospectus. So you can use, you can subdivide the prospectus in several parts. You can have one part that relates to the issue only and get this approved. This is then called the registration document. And you can also then have a second part that relates only to the securities. This is called the securities node. And finally, there's a summary. The securities node and the registration document as part of a tripartite prospectus has not necessarily been being approved by the same national authority. So it could well be the case that you use registration document that has been approved, for example, in Ireland, and a securities note that has been approved in Germany. Together as a prospectus. This requires that then the registration document has previously been notified into Germany. This makes an approach with regard to issuer disclosure more efficient because it's not necessarily required to have an issuer disclosure and issuer risk factors being approved in several jurisdictions. For example, if you want to use the same issuer document disclosure for an MTN program or for a structured notes program, for example. I have set out the details of a registration document on the next slide, but in terms of time, I want to give you a short overview how a prospectus will look like on the next slide. Usually, the prospectus is structured from the different elements of the regulation, i.e., from the issuer part and from the securities part. So a prospectus in the EU usually starts with a summary and then a risk factor section that starts with the issuer risk factors, and then there will be the securities risk factors. So issuer risk factors and security risk factors may not be mixed with each other. If there's a guarantor, the guarantor risk-related risks are part of the securities risk factors. Looks a bit strange because the guarantor is more or less regulated like an issuer and has to be disclosed and also described like an issuer, so that usually one would think it's more closer to an issuer risk factor than to a securities risk factor, but it's officially part of the securities risks. Then in the prospectus you have a description of the issuer as well as then a description of the securities, which includes a description of the guarantee and the terms and conditions of the products. And finally, there is a description of the offer and the admission to trading, and if there's a base prospectus, a format of the final terms will be included in the prospectus. And all the minimum disclosure requirements are regulated, as I said before, by a delegated regulation. The base prospectus, as it is often used for structured products, can be used for whatever type of structured product. There's no limitation. The only limitations are set by national authorities in terms of that they might think that the prospectus might become too complex if very, very complex structures are mixed with each other. Like capital protection products, leverage products, or other products within the same base prospectus. This is a difficult task. So also with regard to the new laws, we have seen more and more structured product issuers using more than one big and huge prospectuses for their products and subdividing their prospectuses with regard to certain product types. A base prospectus is valid for 1 year, so you can use it for 1 year and only need to update the prospectuses if there is a material change, for example, to the issuer that needs to be then needs to give rise to a supplement to the base prospectus. As I said before, this base prospectus only has to be approved once by the national competent authorities. The relevant final terms thereafter don't have to be approved. They will only be filed by the regulator with regard to each issue. The final terms then determine which of the options and the products in the prospectus will then be used and give all the details with regard to the issuances. And with regard to mass products, it's even possible to have one final terms document that documents several series of warrants, for example, that just deviate, for example, with regard to their strike price. So you can then use a kind of a table that gives the functionality to use just one document for several securities. However, there is a disadvantage now under the new law, as I said before, the summary is limited to 7 pages, and if there would be too many too many products documented under one final terms, the length of the summary could not work towards the number of, for example, ISINs used in the final terms. This is why we currently see a move away from these kind of series final terms back to more single product final terms. Because this is more and more possible here in the European Union, because the documentation is much more automized than before. I now want to come back on the. I want to come to the important aspects on the new Prospectus Regulation with regard to the experiences from the approval process of the relevant national authorities here in the European Union. I think what is quite important if it comes to retail distribution, there's much more and more concern by regulations about the plain language and the transparency of the prospectus. So as with respect to the last 11 months, we have seen many issuers restructuring their prospectuses, making them even more simpler, or even subdividing prospectuses in several prospectuses to limit the number of products or the number of underlyings that are set out in the relevant prospectuses. So slimming down prospectuses from more than 1,000 pages to maybe only 300 pages. But this requires then having more prospectuses in place, but the regulator, at least here in Germany, is in favor of having more prospectuses set up in the same style and just deviating in terms of payouts, for example, in certain product-specific risk factors. Also, with regard to the approval process, it has been more efficient nowadays. It has become more efficient nowadays because regulators accept comparisons between an approved prospectus and a new prospectus, so that they only have to review that part that have not been reviewed by the national competent authorities before. So most of the boilerplate stuff of the prospectus, or for example, if the issuer disclosure has not changed, the national competent authorities then only check the differences of the new prospectus that has been filed for approval, and usually not again review the parts that have been approved before. So at least there is some relief in terms of efficiency of approval process. If it comes to plain language, the regulators often say they don't play a language police, so to say, but they look at simple languages. They really like examples, if certain examples are given to certain complex disclosures, or if it's possible, even give some explanations of payouts. And they even would like payout scenarios or illustration to structure a payout, but this has not been made so far in this market. But it has at least been promoted by some regulators that they would like to see that, but it has not. This option has not been used by issuers so far. As I said before, risk factors is the most important change in the regulation. And here we still see in the European Union lots of different approaches by regulators when it comes to the question, what is a risk factor that is specific to the issuer and specific to the securities, and how to make a risk factor specific is very different. The requirement is very different between the national authorities at this point in time. Some of them are stricter and others are not so strict. In particular, the regulators are concerned that it's not a copy and paste exercise that will be used, so that there's a real differentiation in a risk between bank A and bank B, because the regulator thinks that they are different entities and should have different risks when it comes to their, for example, credit risk. We had some discussions with regulators about specifically when it comes to structured products, because warrants are structured in a way that are quite standardized. Yeah, so it's very difficult to say that a warrant of Bank A is different in terms of risk than a warrant of Bank B. I think we convinced the regulators in that respect, but at least they want to see some specifics with regard to risk factors if different payouts of warrants are used. In terms of time, I also want to mention two other topics. The new law doesn't only require to set the scene for specific and material risk factors. They also mention that the issuer should give an estimation of the probability of their occurrence and the expected magnitude of a negative impact of a risk factor. This is quite difficult to achieve, even in particular if a base prospectus is used, because the probability of the occurrence of a total risk of loss of a knockout warrant is very difficult to describe in abstract without knowing the underlying. Yeah. So we discussed this as well with the regulators and find some way forward to cover this point that is on level 1, and regulators says it's a requirement of level 1. This is why we need to see at least some kind of disclosures with regard to probability. But as I mentioned before, it's not something that you can set out in detail with regard to base prospectus. With this remark on risk factors, I want to quickly come to the last element of risk factors, and that's the requirement of categorization. So risk factors must be set into several categories within the relevant risk factor section. So there must be a couple of categories for the issuer risks, and there must be a couple of categories for the risks regarding the securities. On our slides on page 34, I set out a possible categorization that can be used. And what is very important from the regulation is, with respect to each of these categories, the most important risk factors have to be named first. So it doesn't mean that all the risk factors in a category has to be ordered from the most important risk factors to the least important risk factor. That's not the requirement, but the requirement from the law says that the most important ones have to be named first. With this remark, I'm concluding my presentation on the market access and in particular on the prospectus regulation, and now I'm handing over to James Taylor on the changes if Brexit will finally occur.
Thank you, Patrick. Good afternoon, everybody. Looking at UK financial services post-Brexit is somewhat like looking or gazing into a crystal ball at present. As Chris mentioned at the very beginning of these slides, the UK is, with the mutual agreement of the EU, currently in a Brexit transition period, which is due to expire on the 31st of December of this year, unless it's extended at the mutual agreement of both the EU and the UK government, which is, again, as Chris had mentioned earlier, unlikely to happen. There is significant pressure on the UK government not to agree an extension to the transition period, and I think it's worth just setting the scene, because as long ago as October 2016, our then Prime Minister, Theresa May, had promised what she called, it was almost the holy grail of the Brexiteers in the UK Conservative Party, a Great Repeal Bill. And that Great Repeal Bill was intended to remove the supremacy of EU law in the UK forevermore. And we're now almost 4 years later, and thankfully I can tell you everything that Patrick has said in this presentation in relation to EU financial services law, regulation, directives still applies in the UK even today, and will do until at least the end of the Brexit transition period. So this is good for everybody that is listening to the presentation, because everything that Patrick has told you about EU financial services legislation up to now still applies in the UK. We only need to look at one regime, European Union and the UK, but that does carry significant negative symbolism and politics for the Brexiteers in the UK Conservative Party, who are very much pushing for no extension to the Brexit transition period and a brave new world for the UK post 31st of December, where the UK begins to decide its own UK financial services regime going forwards. And just looking at the slides, during the Brexit transition period, the European Union Withdrawal Act 2018, it effectively does what the transition period requires of the UK, which is preserves UK legislation implementing EU financial services law and regulation in the UK. It converts that law, which was directly applicable EU legislation, into UK domestic law, which is called onshoring of EU law, and then it adjusts that EU law for the post-Brexit transition period to enable the UK to continue to have a functioning UK financial services regime, but adjusting it to the fact that post the transition period, the UK will be outside of the EU, and that items that Patrick has mentioned earlier, such as the ability to passport financial services in the EU, will no longer apply to the UK. But key to note is that the secondary UK legislation, which adjusts EU law, only applies post-Brexit transition period, so it doesn't apply currently, and we're in a period at present where EU law is applied, or directly applicable EU law is applied identically in the UK as it is in all other EU member states. Turning to the next slide just shows how that is effectively playing out, or will play out, post-Brexit transition period. So currently, all EU directly applicable EU financial services laws apply in the UK, just as they might apply in Germany or France or any other member state of the EU. Post-Brexit transition period, the UK government is aware, notwithstanding perhaps its ambitious plans to change certain aspects of EU financial services law going forward, that it does need a functioning law book on day one. So as the European Union Withdrawal Act 2018 not only preserves UK legislation implementing EU financial services law, but gives the UK regulators, such as Her Majesty's Treasury, HMT, and the Financial Conduct Authority, the ability to, through statutory instruments, that secondary UK legislation, to amend EU law to make it function appropriately post-transition period when the UK is no longer considered or deemed to be a member state of the EU. So that would be in areas such as, for our purposes, the public offer rules in the EU, which are covered by the Prospectus Regulation, or the ongoing reporting requirements that are covered by the EU Transparency Directive. As Patrick mentioned earlier, the PRIPS regulation, which governs marketing materials for certain structured products, market abuse, insider dealing rules, the benchmarks regulation. All of these items are going to, through secondary legislation, continue to be applied in the UK, but through the statutory instruments, they will be adjusted to an extent. And that extent is set out on the slide, and it's broadly consistent through all of the statutory instruments. So in effect, the UK market will be its own insulated market post the Brexit transition period. EU member states will be treated as third countries, so non-EU countries, like any other non-EU country, such as the United States or Canada. The passporting rights of EU financial services firms will be revoked. So just like a UK issuer of bonds that has a prospectus approved by the UK Financial Conduct Authority will no longer have the rights in EU law to passport that prospectus for a public offer in Germany, the same position would apply to a German company that has its prospectus approved by the BaFin. It will no longer be able to simply passport that prospectus to undertake a public offer in the UK. So those passporting rights will be revoked. And then, one of the other, key items that UK Brexiteers have always considered to be important is that the functions of the EU regulators will be transferred to UK regulators, which means the likes of the UK Financial Conduct Authority and the Prudential Regulatory Authority will have a much bigger mandate in the UK to basically provide guidance and ongoing review of aspects related to marketing, preparation of prospectuses, ongoing reporting requirements, market abuse, product governance, capital requirements for banks and insurance companies and the like. Just moving on to the next slide. The next slide simply sets it out in more detail. So all of these EU regulations are effectively imported into UK law, with just some very minor adjustments which are set out on this slide. Turning to the next slide, I think what is important to know is that, notwithstanding the fact that passporting rights of non-UK companies are being revoked post-Brexit transitional period, the UK government and the UK regulators were well aware that many international banks currently hold rights and authorizations and permissions to conduct regulated activities in the UK, whether that might be accepting deposits as an approved person under the UK Financial Services and Markets Act 2000, whether it's approving marketing materials through the UK financial promotion regime, whether it's through the Markets in Financial Instruments Directive, MiFID II, complying with product governance rules. And the UK government thought it was important to ensure that, at least for a limited period of time, EU firms that have operated successfully and within the scope and the ambit of EU laws and had passported those services into the UK will continue to be able to do so. So the UK government has brought into force a temporary permissions regime, which for a short period post the Brexit transition period will allow EA firms and investment funds, so entities that have regularly been undertaking regulated activities in the UK, to apply under the temporary permissions regime to continue to undertake those regulated activities. And that temporary permission that these entities can obtain through their application is currently due to stay in place for a maximum of 3 years. So that is something that many EU firms have benefited from. Unfortunately, there isn't a reciprocal arrangement from the EU for UK firms, though there is a patchwork of kind of national frameworks that have sprung up in many member states of the EU, such as Italy and France, which is going to allow some degree of regulated activity to continue to be undertaken by UK firms at the end of the Brexit transition period. I think I was going to let Chris jump in now if he had any thoughts on this particular slide.
Well, you were, James, but I wonder if we're short of time, you might want to move on with your presentation. Do you want to, should we keep going?
Okay. We can move on. So the next slide is really looking at where we might end up in the UK saga as to staying very much in alignment with EU laws and regulations, or achieving the goal perhaps of, or the dream perhaps of many Brexiteers in the UK as long back as 2016, to effectively diverge from EU law, make UK law supreme, and effectively create a new financial services regime for UK firms, which would allow us to leverage off the UK's global financial services exports. And there are those, as Chris mentioned at the beginning of this presentation, that are very much in favour of EU equivalence, clearly benefit in maintaining the current equivalence or the identical rules that we have with the EU is even more pertinent during this year, with COVID-19 taking up much of the time of Whitehall and the UK government. But more so just looking at the economics. I mean, it's very clear that there are many in favour of maintaining EU equivalence. For example, recently, Sam Woods, who's the Deputy Governor for Prudential Regulation at the Prudential Regulatory Authority, made it very clear that out of the UK's £280 billion financial services sector, roughly 30 billion of that is with EU clients, and it may be that up to 50 billion is related to the EU in some way. So it's very clear that the EU financial services market is critical to the success of the City of London and other financial services centres within the UK. Supporters of equivalence will also look at the fact that the UK government itself, within the political declaration that was signed alongside the Withdrawal Act, made it plain that they were looking towards creating a so-called level playing field with the EU. So from the side of the supporters of looking towards an equivalence regime with the EU, those supporters would say to the Brexiteers, well, look in the political declaration, what you want is outside of what the UK government has currently agreed with the EU to seek to achieve. On the other side of the spectrum, there are many proponents, not just the Brexiteers, but of many UK parliamentarians, both in the Commons and the House of Lords, that have really solidified their views that divergence from EU laws and regulations are really important to the growth of the EU financial services industry. They look at the fact that the EU Commission has continually rejected any calls from the UK government for an enhanced equivalence regime for the UK. They look at the ongoing situation that has circled Switzerland in recent years, where the equivalence decisions that the EU Commission had made about share trading in Switzerland had been revoked because Switzerland would not agree a single EU-Swiss political agreement. And they look at the fact that equivalence decisions can be removed within 30 days unilaterally by the EU Commission, and basically decide on that basis that the UK really needs to form its own or create its new path in the financial services world. So there are big divergences between those two sets of proponents, one for equivalence and one for divergence from the existing EU financial services regime, and there isn't really much middle ground between the two. I think what is clear is that there's not going to be any immediate bonfire of regulations. The UK government is obviously taken up with ensuring that the COVID-19 situation is brought under control within the UK. The statutory instruments, we've looked at a few of them, but there are over 600 statutory instruments which have had to be prepared by Whitehall, have taken an immeasurable amount of time to prepare, and there just isn't the capacity or the bandwidth within the UK government to simply revoke all EU regulations and forge a new path. And so currently what's been decided is that the HM Treasury will, alongside the Financial Conduct Authority, look at new initiatives within financial services regulation, and over the next 2 years will set out those initiatives, and at a later stage we'll be able to see whether we're going to diverge significantly from EU financial services regulation or not. And I think the last slide is just on that point, because Andrew Bailey, who's now moved to be the governor of the Bank of England, but in his role as head of the Financial Conduct Authority, has always been of the view that there are bits of European legislation that just do not work particularly well for the UK, do not work well for counterparties to UK firms, do not work well for necessarily for international banks that are looking to offer structured products or other capital markets products within the UK or indeed within the EU. So I think probably the thing to say about this slide is that we'll be watching the space very carefully, and we believe that there will be divergences, not necessarily a bonfire of the regulations, but there will be certain minor adjustments to EU financial services regulation in the near term when the UK finishes its Brexit transition period. Patrick, just turning over to you so you can sum up for us.
Thank you very much, James. In interest of time, I'm staying short. As you see, it looks like everything is very complex. Yeah, I can entrust you that if everything is probably set up and verified, it's not so complex that it looks like. Also, with regard to Brexit in the future. If there are questions, please let us know. Also, after the webinar, we are happy to answer these questions. And now for the rest of our team, we want to say thank you for joining this webinar. We hope that you all stay healthy and overcome the corona situation healthy. That's very important. And finally, the CLE code again for you, it's 20 BREX0618, and with this conclusion, we want to thank you for joining for me and my partner colleagues, and we wish you a good day. Bye.
Thank you. Goodbye.
Thank you.